Welcome to our educational podcast. Here at Spelling Bee Ninja, we're passionate about delivering high-quality content that makes learning enjoyable and accessible to everyone. If you're curious about how governments handle money and the impact of their decisions on your life, you're in the right place. Subscribe now to join our community of learners and stay updated on our free, informative episodes. Today, we're diving into the world of government budgets and fiscal policy. Understanding how governments balance revenue and spending is crucial, as these financial decisions affect every aspect of our lives. A government budget is essentially a plan outlining how funds will be raised and spent over a certain period, usually a year. The most prevalent source of revenue for governments is taxes. These taxes can come from various forms such as income taxes, sales taxes, property taxes, corporate taxes, and payroll taxes. Imagine you just received your paycheck and noticed a portion deducted for income tax. That's an example of how taxes function to provide revenue for public services and infrastructure. In fact, effective tax collection typically accounts for about 80 to 90% of government revenue in developed countries. Understanding where this revenue comes from helps clarify why governments emphasize economic growth. Simply put, a stronger economy often results in increased tax revenue. This fundamental relationship between economic growth and tax income explains why lawmakers are particularly attentive to tax regulations and the economic environment. Now, let's discuss spending categories. Government spending is not an arbitrary process, it falls into several major categories. Mandatory spending is what the government must pay by law. This includes crucial entitlement programs such as Social Security, Medicare, and various welfare programs. On the other hand, discretionary spending is determined each year through budget decisions, covering expenses like defense, education, infrastructure, and research. Additionally, governments must consider interest payments, which are required to service the national debt, and transfer payments that provide financial assistance to individuals. The largest parts of most government budgets typically go to healthcare, Social Security, and defense. Thus, budgeting often involves tough choices since mandatory spending, by nature, cannot be easily altered, creating a challenging landscape for lawmakers. Moving on to budget deficits and surpluses, these concepts are fundamental to understanding fiscal health. A budget deficit arises when a government spends more than it earns in revenue within a given year. Conversely, a budget surplus occurs when revenue surpasses expenditures. When deficits arise, governments must borrow money, usually by issuing bonds, which contributes to the national debt. Interestingly, it's common for nations to experience deficits, particularly during economic downturns when tax revenue drops and spending on unemployment benefits rises. Conversely, surpluses can be used to pay down debt or saved for future needs. So why is the national debt important? The national debt is the total amount the government owes, accumulated over years of deficits and surpluses. Understanding the dynamics of national debt helps you grasp fiscal health debates, as moderate debt may be manageable. However, excessive debt can create burdens through interest payments and limit future borrowing capabilities. Evaluating national debt also depends critically on the economy's size and growth. Debt becomes more manageable during periods of economic expansion. Next, let's differentiate between types of fiscal policies, expansionary and contractionary. Governments implement fiscal policy to manage monetary conditions. Expansionary fiscal policy aims to stimulate the economy through increased spending or tax reductions and is mostly employed during recessions to ignite demand, create jobs, and promote growth. On the flip side, contractionary fiscal policy slows the economy during times of inflation through reduced spending or tax increases. This approach aims to cool down an overheating economic landscape. Understanding fiscal policy dynamics can help illustrate why governments may increase spending during downturns and implement austerity measures during growth periods. Now, let's compare fiscal policy with monetary policy. Fiscal policy involves government actions regarding spending and taxation, whereas monetary policy is the domain of central banks focusing on controlling the money supply and interest rates. Coordination between fiscal and monetary policy is essential. When both policies align effectively, economic management becomes more robust. Grasping these distinctions is central to understanding how different institutions tackle economic issues. As we discuss budgeting, it's imperative to recognize the trade-offs involved. Governments often face challenging choices regarding prioritizing spending between competing needs. For example, consider investments in defense versus education or healthcare versus infrastructure. The trade-offs demand careful consideration of both political and economic factors, as different political parties may advocate for varying priorities based on the needs they represent. Understanding these complex trade-offs can help clarify why budget discussions often become heated and contentious. Lastly, let's talk about stimulus programs during economic crises. To stimulate demand and accelerate recovery, governments may implement programs involving direct payments to individuals, infrastructure investments, business support, unemployment benefits, and tax relief. These measures are designed to put money into the economy, fostering spending that leads to job creation and business investments. However, the efficacy of stimulus measures is often debated, balancing immediate economic relief against potential long-term inflation and debt concerns. Historical examples, like the stimulus efforts during the 2008 financial crisis or the COVID-19 pandemic, illustrate the critical role government spending can play during emergencies. In summary, government budgets and fiscal policy are indispensable tools in managing a country's economy. We've explored aspects like revenue sources, spending categories, deficits and surpluses, national debt, and the various types of fiscal policies, along with trade-offs tied to government budgeting. Now more than ever, understanding how public money is managed not only clarifies the role of fiscal decisions in your life but also empowers you to engage thoughtfully in public finance discussions. Today, we learned that government budgets reflect the priorities of society, while fiscal policy can significantly influence economic growth, employment, and inflation. We discussed how managing deficits and debt is crucial and why government budgeting involves difficult trade-offs. Finally, we recognized that fiscal policy works in tandem with monetary policy to achieve economic stability. By understanding these concepts, you'll be better equipped to analyze how decisions made at the governmental level impact daily life. Thank you for joining us on this journey through government budgets and fiscal policy. We hope you found it informative and engaging. Remember, knowledge is power, and understanding these economic principles can help you navigate the complexities of public finance. Don't forget to subscribe for more episodes like this, where we break down complex topics into understandable lessons that empower you in your educational journey.